are now on the mock one, looking at the long questions, okay? And the first question is to outline very briefly, using a number of the various stages in initial public offering, okay? So the professor tells us, which we know anyway, that an initial public offering, okay, is when a firm is essentially going public. Okay, it's the first listing of the company and the trading of the company's securities for the first time on a public exchange. Could be over the counter, New York Stock Exchange, et cetera, et cetera. Okay, all right. But so the first thing that the company would do would be to hire an investment banker. This professor calls it a lead sponsor, but in the United States we would call it an investment banker. He would work with the company to determine, first of all, whether or not he believes that the company has the track record, has the strong financials, and can justify bringing it to market an initial public offering. Okay, he will advise the board whether and what the price he thinks he can get, and whether it makes economic sense for the company to proceed with an IPO. Okay, should the board, decide to move ahead, the investment banker would put together a timetable, and he would put together, the prospectus, which is the document that is going to be used to explain the company, its financials, what it's going to do with the money that it's going to get from the IPO, and put together, which essentially is in some sense a marketing document, which will, be used to convince the public to buy shares in this initial public offering. They will then put together, normally the underwriter does this. He talks about a lead sponsor. I wonder if that's a British term.
Oh, maybe.
Yeah. I mean, so the team will be rounded out, by including, in addition to the underwriter, the accountants. See, in Britain they have a broker. There's no broker in the United States.
Okay.
Every public company in Great Britain, England, has what they call a broker.
Okay.
And the broker sort of keeps an eye on the stock. They don't have brokers in the United States, all right? Okay. So they'll put together a team, depending on what country it's in. The underwriter has probably already been hired, the accountants, the lawyers, and we call that a syndicate to put together to prepare the documents, so forth and so on. And this team gets paid, from the proceeds of the IPO.
Okay.
All right. Okay. So after the documents have appeared, they will, in the United States, they will go before the Securities and Exchange Commission.
Okay.
To be reviewed, and the SEC will determine if it's okay, and there'll be some back and forth regarding changing certain documents, looking at the projections, and eventually the IPO, will be approved by both the company, the underwriters, and in the United States, the Securities and Exchange Commission.
Okay.
Here they call it Impact Day. In the United States, it's the day when they go public with the documents.
Initial public
offering. Yeah, the price is established, and various people that are going to buy shares of the stock. It could be people in the company. It could be the public. Could be other underwriters. Will offer. And offer to buy shares at the initial price. But if there's great demand, as you know, the price of the stock will increase during the day. And it may in fact end up much higher than it went out at the beginning of the day.
Or lower.
Yeah, like some of the Tesla and other kinds of stocks. Finally, it'll close. The shares will be distributed, and the money will be given to the company, and that will be it. If the stock is having trouble being sold, then the underwriter, okay, may have to buy some of the stock for his own portfolio
Okay.
and keep that stock and eventually sell it. But he generally has an obligation to see that the IPO gets done,
Okay.
certainly at the price that he committed to the company to do it.
Gotcha.
Okay?
Okay.
All right, so that's the IPO thing, right?
Okay.
Okay, so next, let's just take a look at the next one. Give 2 reasons why the company, okay, all right. So we don't have to write about these, we just give, here we are. Give 2 reasons why a company, name a possible disadvantage of going public. All right, so the next question in that same text is to give 2 reasons why a company might decide to have an IPO, and also at the same time to name a possible disadvantage of going public. And there are several answers that we could talk about. Number one, okay, the private owners, the people who originally got the company going, may have put a lot of their own money into it,
Okay.
and by going public and bringing and selling their own stock, okay, they're starting to recoup some of the capital they initially had put into the company. Number two, the company may be at a stage in its development where it wants to expand, okay, and it needs more capital to do so, and the IPO gives it that capital to do so.
Okay.
Okay. Another reason would be to generate interest in the company. Okay, an IPO always generates, if you will, some quote unquote free advertising about the company. Okay, and if you're going to issue to increase liquidity of shares. Because equity, okay, does reduce the cost of the capital. So the more shares, let me see, I don't know why it would reduce increase liquidity of shares. Well, you're going to put more shares out. Okay, so you might get rid of them. You might retire some debt, and shares generally reduce the overall cost of capital because you can or cannot decide to pay a dividend.
Okay.
So if you have debt, you're hooked into a payment on a bond or a bank loan. If you're going to issue more shares or issue an IPO, you might use that to pay down debt and therefore overall reduce your cost of capital.
Okay.
Okay?
Okay.
All right, okay. Some disadvantages of going public. Okay. No question that by getting the SEC involved and so forth and be getting a reporting agency involved, you are going to be subject to much more scrutiny of your company and much more burdensome and onerous reporting standards. Okay? It does put more short-term pressure on management to meet earnings goals, okay, and to match the projections that you used in the IPO.
Okay.
Okay? And you're increasing the number of shareholders that are in the company, okay? And it just makes, and assuming that we buy the principle that management is beholden to the shareholders, it gives management more bosses to worry about on a day-to-day basis.
Gotcha.
Okay, good. All right.
Okay. Cool.
Okay, so what was the next one? Just a reason why we tend to observe how the companies deliver a return in excess of 10%. I'm not sure they did, but let me read this for a minute. Hold on.
Okay.
Suggest what we tend to observe. Left the table. Submit a reason why we tend to observe the companies deliver a return in excess of 10%.
So why does the stock jump so high in the first days?
Is that what you think that's what they're talking about?
Probably
Okay.
good. It goes back to
Yeah,
the
right,
marketing
okay. Hold
perception.
on, money's left on the table. For a
Struggle.
number of reasons.
Interest.
This benefits underwriters, okay. As a return to investors comes in the flag. Okay. To ensure that investors return for the, okay. Okay, all right, so the next optional question, okay, in this whole area of IPO is to suggest a reason why we tend to observe that companies deliver a return in excess of 10% in the first few days after an IPO And what we're assuming that means is that the cost of the stock, the price of the share goes up by at least 10% in the first days after the IPO. And we believe that might happen for a number of reasons, okay? Because more investors learn more about the company, okay, and therefore there's more, okay, stock, okay, that there's more demand for the company in later days as more companies, okay, as more buyers learn about the company, okay. If the stock does increase, that's a good sign that the next time that there is a sale of shares of the company, people will be excited about buying it. And last but not least, okay, to ensure that the issue is fully sold out,
Okay.
okay, as the stock gets higher. Okay?
Okay.
All right. Preferred shares. Well, yeah, my raise base, yeah, we know that. Right. Right. Okay, and the last question in this section on IPOs is to suggest 2 reasons why a young company might raise capital by issuing preferred shares rather than debt.
Okay.
Okay, in one of our previous lessons, we spoke about preferred shares. Okay, and preferred shares might have the following advantages to the issuer being the company that's selling the preferred shares. Okay, that it does not, by issuing preferred shares, you don't dilute ownership of the common shares. Okay, okay, and the dividends, okay, on preferred shares, okay, or any shares are not a legal obligation and can be deferred. Okay, thus a clear advantage when earnings are uncertain. Okay, all right, this is the advantage of the buyers, that preferred share owners are more senior than common shareholders, okay, and therefore more likely to recover their investment in the event of an insolvency. Remember, we spoke about the 3 levels of people that get paid out.
Yeah.
Okay,
Debtors,
the debtors, the
yeah.
preferred shareholders,
And the
and the common shareholders. Okay, and preferred shares normally offer a more higher attractive dividend.
Okay.
Than common shares.
common.
Okay, good. So that handles the first question.
Cool.